Hello, and welcome to the Deep Dives.
Hello.
Today, we're taking a closer look at a pharmaceutical company that's really carved out a unique niche, Caplin Point Laboratories.
Hmm.
And this isn't just about, reviewing their latest financial report. We're diving into their strategic vision and how they're actually making waves globally.
That's right. Our mission today is really to synthesize the key insights from their Q1 FY26 earnings call, their financial statements for the quarter ending June 30th, 2025, and their recent press releases.
Right.
We want to get beyond just the raw numbers, understand the why behind their performance, and sort of explore their distinct approach, how they navigate a pretty dynamic industry.
Okay, so like a shortcut to really getting what makes them tick.
Exactly. Think of it like that. A shortcut to understanding a company that, well, operates quite differently.
So let's jump right in then. What's the headline story from their Q1 FY26 numbers? What immediately jumps out to you about Caplin Point's overall financial health?
Well, what's truly striking, I think, is their consistent and, frankly, robust growth. Okay. For Q1 FY26, Caplin Point reported total revenue of about 533.4 crores. That's roughly 64 million US dollars, give or take.
And that's up from last year.
Yep, an impressive 11.7% increase year on year. And their profit after tax, PAT, which is, a key indicator of their real earnings power, that climbed by over 20% to nearly 151 crores.
Wow, okay.
Their EBITDA also crossed 200 crores, growing by almost 18%. So these aren't just marginal gains, right? They speak to a fundamentally strong, well-managed business.
Those are definitely impressive numbers. But looking specifically at profitability, are those margins healthy? What's driving that?
Absolutely healthy. It seems to be a mix of efficient operations and a smart product mix. Their gross margin for Q1 FY26 stood at 61.7%,
Okay.
up from 59.6% last year. New product launches helped there, apparently.
Right.
And their EBITDA margin was 37.7%, PEAT margin a very solid 28.3%.
So that really underscores, I guess, effective cost management as well, not just new products.
Exactly. It's not just about growing the top line. There's a clear discipline around costs that shows through in those strong margins.
And when we talk about financial health, stability, what does this all mean for their resilience?
Well, this brings us to their pretty impressive cash position. The company really emphasizes significant liquidity.
How significant?
As of June 30th, 2025, they were sitting on free cash reserves of 1,237 crores. That's roughly 148 million US dollars.
Okay.
And total liquid assets of 2,207 crores, about 265 million US dollars.
Wow.
And here's the critical part, I think. They operate with zero borrowing, no finance costs.
Zero. That's unusual.
It really is. And it isn't just good practice. It seems to be a core philosophy for them. Self-sustenance, financial independence gives them incredible flexibility.
Zero borrowing in a rapidly expanding pharma company.
Yeah, that is quite rare.
Their chairman often talks about mastery in the mundane and sticking to the basics. What does that philosophy actually look like in practice? How does it, drive their business?
It really seems foundational for them. Their basics are all about catering to what they call the bottom of the pyramid.
Right, the underserved markets.
Exactly. Providing affordable, high-quality products there. They're explicitly not chasing what they term vanity metrics, like top-line growth at any cost. Instead, their unwavering focus is on the bottom line, which they cleverly call sanity, and critically, cash flow, which they say is king.
Sanity and cash flow.
Yeah. And this guides every strategic decision. Even their pricing philosophy, where they basically say there's no such thing as American quality at African price and generics. Quality should be affordable everywhere.
Cash is king. You hear that a lot. But it sounds like Caplin Point takes it almost to a foundational level, building their whole strategy around it.
It does feel a bit old school in its prudence, doesn't it?
Yeah, it does. And that philosophy clearly informs their geographic strategy. They have this incredibly strong foothold in Latin America, but then this surprisingly cautious stance on the U.S. market. Can you walk us through that?
Absolutely. And this diversified approach, it's clearly a cornerstone of their strategy. It lets them adapt pretty nimbly to global shifts.
Okay, so break it down. Latin America first.
Right. Latin America and emerging markets. This is their core strength, no question. In Q1 FY26, a huge 79% of the revenue came from emerging markets, mostly Latin America and Africa.
79%, wow.
Yeah. And they're consistently expanding there, moving from smaller geographies into bigger, higher potential markets like Chile, Colombia, Mexico. They're even planning an office in Brazil.
So deepening their presence.
Exactly. They opened a new warehouse in Chile to be closer to customers. They've got over 120 registered products there. In Mexico, they've filed over 35 products, 17 approvals already, and a pipeline of 80 plus more products for the next 12 months.
That's a serious pipeline.
It is. And they've also secured big tenders, US $7.6 million worth in Central American markets. So you see deep, consistent market penetration there.
Okay, so LATAM is the powerhouse. What about the U.S. business then? It exists, but cautiously.
Right. Their U.S. arm, Caplin Steriles USA Inc., or CSU, it actually reached profitability within its first year, which is pretty good.
Impressive.
And it contributed 21% of Q1 revenue, growing 36% year on year. So it's not insignificant.
But they're hesitant about manufacturing there.
Very hesitant. The chairman pointed out that U.S. volumes for generics are often too low compared to, say, Indian exports. And building a factory there takes years, costs 5 to 10 times more to operate. Their current U.S. business is overwhelmingly B2B, business to business. That gives them some insulation from potential tariffs, you see.
Right.
They are looking for land and facilities in the U.S., but mainly for warehousing, maybe packaging initially. Manufacturing only if the commercial viability is crystal clear. They seem to view tariffs as affecting everyone, and their direct exposure is limited anyway.
Makes sense. Now, this China 2.0 strategy,
Yeah.
that sounds intriguing. What's that about?
Yeah, it's a fascinating new strategic angle. The chairman recently spent 3 weeks there and highlighted China's shift, from just imitation towards real innovation.
Oh.
So Caplin Point is leveraging this. They're pursuing an asset-light model, partnering with Chinese companies for higher value stuff, biosimilars, peptides.
The more complex drugs.
Exactly. These currently make up about 30% of their outsourcing, and they want to increase that significantly.
Interesting.
And then they're also exploring things like nutraceuticals and adaptogens, functional foods, dietary supplements. They see a big way future there.
Health and wellness focus, okay. And finally, onshored manufacturing. What's the driver there?
Well, it reflects that broader global trend, doesn't it, towards more localized supply chains. Deglobalization, maybe?
Right.
So they're acquiring land and buildings in Mexico and Guatemala, first phase, oral liquids and dermatology products.
And the benefit.
Local production can offer a pretty significant 15% price advantage in the tender business. Makes them more competitive right there on the ground.
Got it. So it's this complex, careful balance. Local presence, global sourcing, partnerships. How does their manufacturing strategy itself, that mix of asset-heavy and asset-light, support this whole thing?
Well, their strength really comes from this hybrid approach. They have invested heavily, around 700 crores, maybe 84 million US dollars, in their own state-of-the-art facilities over the last 5 years, building up those assets.
Right.
But they smartly complement this with an asset-light outsourcing model, using specialized manufacturers, mainly in China and India.
So flexibility.
Exactly. This combination allows for sustained growth, strong cash generation, without needing to borrow. It gives them dynamic flexibility to adapt quickly to geopolitical shifts, market demands, whatever comes up.
Okay, looking ahead now. They've allocated a pretty substantial capital expenditure budget, over 1 billion rupees, right? What are they actually building, and what does this signal for their next growth phase?
Yeah, over 1,000 crores, which is around 120 million US dollars. It's earmarked for investment projects, and about half are already nearing completion.
And all internally funded. Sticking to that debt-free approach.
You got it. All financed through internal accruals, maintaining that zero borrowing status they value so much.
Okay, so what are the current projects?
Well, their API unit, the active pharmaceutical ingredient plant for general category products in Vizag, is done. They're just getting the GMP certification sorted.
Okay, so backward integration.
Precisely. Gives them better control over costs and supply. And construction is in full swing at their oncology API site near Chennai. That should be done within about a year.
And future facilities.
They're designing an OSD, oral solid dosages facility in Puducherry. Target completion is Q3 FY27. And there's a Caplin 1 Labs injectable facility under construction too, slated for Q4 FY27.
Right, but I remember reading about a delay in one of those, the OSD facility.
Oh, yes, good point. Management explained that. It was apparently a deliberate wait-and-watch decision.
Wait and watch, why?
Well, in a dynamic environment, they preferred to delay rather than rush the investment. They actually found adequate contract manufacturing options in China and India in the meantime.
So the delay didn't really hurt operations?
Apparently not significantly. Made the delay less impactful. Strategic patience, you could call it.
Interesting. Beyond the buildings, they also mentioned a big focus on complex products and R&D. Can you tell us more about their innovation pipeline? What are they working on?
Certainly. Their R&D setup looks pretty robust, 372 professionals across 5 dedicated centers.
Okay.
They've already completed R&D for over 90 APIs for that backward integration we talked about. That really strengthens their supply chain.
Mhm.
And strategically, they're targeting niche segments, things like pre-filled syringes. They've got 7 products planned for filing within the next 12 months.
Okay. Complex delivery systems.
Exactly. And what's particularly noteworthy, I think, is their plan to launch GLP-1 products.
Ah, the big diabetes and weight loss drugs.
Those are the ones. They
Right.
aim to launch them in their Latin American markets next year. But importantly, focusing on differentiation for that bottom of the pyramid segment, making them accessible somehow.
That's a key challenge. Affordability.
Absolutely. And they're also actively exploring biosimilars with partners in the EU and China and planning a new fill-finish facility in India to support that push.
So it sounds like a blend of, well, strategic caution on things like U.S. manufacturing, but real ambition in R&D and market expansion. What about their long-term growth aspirations? How confident do they sound about keeping this momentum going?
Management expressed strong confidence, actually. They anticipate achieving a robust double-digit growth rate, think 20-25%, but probably after FY 28-29.
Okay, so a few years out for that level. What drives that confidence?
It seems to be fueled by expanding deeper into those larger LATAM geographies like Mexico and Brazil, getting more product registrations through, and potentially making meaningful acquisitions, maybe products rather than whole facilities, aligning with that cautious approach.
Right, product acquisitions fit the model.
Exactly. They believe their strategy of keeping goods close to the customer, plus their growing U.S. label business and the Smart China outsourcing, that combination will sustain the momentum.
Any other indicators of that confidence?
Well, they did mention some reshuffling within their R&D senior management, specifically bringing in new people capable of handling these more complex product pipelines they're building, so investing in talent, too.
Well, that was an incredibly insightful exploration into Caplin Point's Q1 performance and really their whole strategic roadmap. We've definitely seen a company that's not just reporting numbers, but very thoughtfully executing a unique, cash-focused business model, a clear vision there.
Indeed. I mean, Caplin Point's story really illustrates the power of a clearly defined niche-focused strategy, especially in today's volatile global market. Their emphasis on mastery in the mundane, that prudent financial management, the adaptable supply chain. It offers a compelling case study for any business navigating uncertainty, I think.
So for you, our learner, maybe consider this. In this world that's increasingly interconnected yet also kind of protectionist, where does true competitive advantage lie for pharmaceutical companies now? Is it just sheer scale? Is it purely groundbreaking innovation? Or maybe it's in that quiet, consistent dedication to the bottom of the pyramid, combined with these strategic, localized supply chains.
Something to mull over.
Definitely something to mull over until our next deep dive.